Well, welcome back to Corellian Academy. It's been a wild couple of weeks whilst we've been away, and I think it's now time to look at some of the major events of what's going on at the moment. And to be honest, one of the major ones we have is the growing recessionary fear we have amongst global economies, particularly the developed world. And in recent weeks, we've seen increased potential of a global recession, which has driven negative risk sentiment across financial markets. We've seen stock markets fall pretty heavily, actually, particularly in Europe, a bit of a catch up down to some of the others. We've seen the German 40 daily, as you can see on the chart at the bottom here, having a bit of a torrid time. Some real fears about what an energy crisis could do to the European economy going forward with the ongoing situation with Russia and Ukraine. And to be honest, those sanctions that they've got in place look like they may be in place for some years. We've seen the 10-year bond yields rise and then fall. What we do see when we see or what we do feel when we see these bond yields fall heavily in the 10-year space is a fear growing amongst investors that in the future we're going to see slower growth and potential slowdowns in the economy or even recessions. And this is important because this impacts all things around financial markets. As we can see, if we look at, say, the commodity sector and we hike out copper, which is deemed to be the bellwether of economic health for the global economy. Well, just one look at this chart on the right here, since the 2nd of June, a bit of a collapse, to be honest. And this is fears over demand with a slowing economy. And it really is something of a canary in the coal mine, this. And, falling 21% in June is not something we see very often. Even oil as well. So, these are ongoing issues, and there's very many issues building up to suggest that finally now investors realize that the Fed and other global central banks are determined to tighten financial conditions. That is negative for growth and negative for stocks. Deal with inflation at all costs, including economic growth. We've heard that quite clearly from the FOMC and Powell in particular. And also we've seen, further rate hikes. We saw the RBA hike 50 basis points on back-to-back meetings. That's the first time I've seen them do that. It's fairly aggressive front loading, if you like, of interest rate hikes to try and get this inflation genie back in the bottle. We've seen a pullback in US manufacturing as well. The manufacturing surveys we've seen have weakened. We saw particularly weak new orders, components in there, and weakening employment components as well. And from that, we've seen US stocks start to fall. And we've seen Wall Street, the 4-hour, the Wall Street 30, what we call the Dow, dipping down into the middle of June, trying to bounce, and then really failing again, to be honest. And it looks very vulnerable again. So some real nervousness around stock markets. But I will say one thing, the fear indicator, the VIX is still not highly elevated. So it's fairly orderly fall. We've got earnings coming up, and these are going to be very closely monitored. And you can actually get the earnings calendar on your system here, Plus500, have a good economic calendar there for you to look it up. You can see who's coming up in the near term. And it's worth keeping an eye on these, especially if there's any disappointments, and also look out to what some of the CEOs and CFOs have to say about the future. The market will certainly be looking at these. There is a fear that the recession coming could actually create something of an earnings recession as well. And that is negative for equities. So we need to be careful of that. So corporate earnings do matter, and they have a potential to create market volatility going forwards. Not all of them would be bad, and some of them may be awful. So if we look at the what we call the S&P 500, the USA 500 4-hour chart here since the 1st of June, you can see the lack of confidence moving into the mainstream benchmark US stock market. We have had a bounce, but it couldn't hold, failed to break above the or close above the recent highs, back down again. And earnings matter to a lot of investors and traders. They have to. That's what drives stock markets. So we've seen these mini bounces from a few times. To many, this still looks like a bear market with bear market rallies, which are seriously getting faded every time we see them. So the negativity is still there, but we are seeing some wild swings outside of equity markets. We're getting a steady move down in stocks, but we're getting violent moves in bond markets. Now, these bond markets are supposedly where we have the calmer waters, not so. And this stress in bond markets is really quite concerning. Whereas the VIX, the fear index in equity markets, is actually rather muted. And this again is because the fall is not really violent. It's not a crash and bounce, crash again. It's steadily falling off. As you can see in the sort of overall trend, if you pull up a daily chart of some of these stock markets, you'll see the trend moving down rather than a sort of violent swings that we're seeing in bond markets. So this volatility, though, has a habit of spilling out from one market to another. And we've seen heightened volatility in commodity markets and foreign exchange markets, particularly foreign exchange, where the dollar has started to soar back into new highs recently. So a lot going there. So could stocks be facing an earnings recession later this year? I think there's a danger of that, and we need to consider that. Q2 earnings and forward guidance, more importantly, I think will be monitored, the forward guidance especially. And I do think that some of these earnings out of Q2 earnings that we're going to get next week could start to sort of rattle a few nerves, if you like. And I think the market and the investors particularly are fairly fragile at the moment, and these could have an impact. So we need to be careful that this volatility doesn't spread. But corporate earnings can actually throw up potential opportunities. A recent Bloomberg survey highlighted investors, I think analysts will need to adjust their forecast down. Now, to me, forecasts are far too high. I think, we've got global earnings estimates here on the right in the chart here, seriously at odds with what prices are doing in stock markets as well. So therefore, I think there is opportunity here. Does that mean that the downside has not been finished? That gap looks wrong to me. And I'm not sure that stocks are going to catch up to earnings. I think earnings may catch down to stocks. That's just my opinion, but it seems strange that earnings are still being held up so high on forecasts. We may get the reality hit over the next couple of weeks. So consumer discretionary spending is falling. That's not good for the retail sector, which has been punished. The psychology of the market definitely shifting from inflation concerns to all being about potential recessions and slowdowns. I'm not sure if that's necessarily right, because we might get a bit of both. Inflation may take a lot longer to fall back down on a demand drought than people think, because the supply issues, particularly in commodities like oil, are still there, and computer chips as well. So is sentiment too negative? So squeezes are likely. The squeezes are always likely in stock markets. They happen all the time. Some of the earnings will be good. Some of the earnings will be awful. So there's going to be volatility in equity markets, and I think there's value in some of those if you're a short-term trader. Or is the next movement lower potentially about to come in the month of July? To be honest, that's a tough question. July is normally, or seasonally, if you like, a strong month for equities, and because cash does flow in. But if July is a bad month, then I think we have a few more problems ahead. So we need to be pretty careful here. We've got some pretty downbeat earnings revisions starting to show. Only just recently, though, and I still think these have got a little further to move down. If you look at this chart on the left here on the bottom, the next movement lower potentially about to come in the month of July is a possibility, looking at those. So equity analysts are always upbeat. It's a default mechanism for these guys. They sell the product. It's in their interest for stock markets to go up. So these forecasts look to me to be slightly optimistic. Let's put it that way. The hit to corporate earnings could be quite rapid and extreme. I think more so maybe in Q3 than from the Q2 earnings. But many companies have survived on low interest rates. Those days are gone. The days of free money are over. And some of these companies have literally survived because borrowing costs are zero. So typically during a session, the USA 500 earnings drop about 13%. We haven't seen anything like that. We should be at the start of a seasonal rally for equities. If it doesn't come, then I think, we are going to have a nasty end to July. So we need to keep that in mind. Is there pent-up demand in markets ready to unleash a wave of confidence in stock markets? It depends on the data. It depends on things like maybe China completely unlocks and starts this pent-up demand back for demand for commodities and things. It may change things. But July, I think, is a bit of a pivotal month for equities going forward if the seasonals don't kick in. Now, even the banks, which have done really well with higher yields, are starting to fall pretty hard. Now, JP Morgan is the most successful bank in the US and probably one of the most successful in the world. This is how they've got on since January. Not that impressive, and they can't hold a rally in the stocks there. So US bank earnings, which start next week, are going to be really important to the market because these are the ones that usually get the earnings season off to a good start. So are they concerned over the amount of economic hard landing and stagflation coming? I think the banks are not happy or will perform worse due to falling yields. They usually perform better with higher yields. So, I think we also have to ask the banks at what levels they have for bad loans on their books. Now interest rates are rising. Will all those loans be able to be paid up on time? And are there going to be more corporate defaults on the back of this? So that's what we have in front of us. I think it's going to be a very interesting time. I'll be back in a couple of weeks and we can look back on some of this and see exactly where they are. I hope you've enjoyed the webinar so far. We'll be back in a couple of weeks.